Do you think I work out? I don't. I haven't worked out in months. Not even done a single bicep exercise. But well. Hmm. Anyways, back to the second part of the resilience architecture video that we started previously. It's been 2 days. I wanted to film last night as well, but I had to be up early morning. Technically, yesterday, given it's 3 a.m. now. So, last night, but last night, I don't know what you want to say. Whichever is fine. Anyways, so I didn't film then. And actually, I was contemplating on making a invisible crash video on sibling rivalry, but I'm not in the mood anymore. So let's focus on actually doing some work and reading through it, as I promised my mom that I was gonna study, which is technically work ish to some extent, if not primarily about our business, but still wealth and protecting the wealth. And I remember this one dialogue from the movie Durandar, where Dawood Ibrahim in the movie Durandar 2 said that बादशाह बनने से भी ज़्यादा मुश्किल है बादशाह बने रहना, which means yes, it's difficult to be the king, but it's even more difficult to remain the king, you know. So, wealth protection, because it may be difficult to be wealthy or be very rich, but it's also important for you to protect that wealth, because we have fair examples of like people like Vijay Malia who aren't that rich anymore, you know, getting lost in their flamboyancy in politics. So here is where we try to figure out how we can shield ourselves from the politics, multiple jurisdictions, and blah 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 blah. We covered that in the last video. You can have a look if you want. Anyways, hey, my stretch marks, fuck that. Anyways, let's go back to reading. Okay, so now we are on part number 5. So we are at the 50% mark, but we are getting started with that. So we are at the done with the fourth. We're done with the fourth part. So is it 40% done or 50%? Neither or. Okay, so part 5 is the resilience architecture, where the first one is a corporate architecture. So the design principle is that the corporate structure exists to determine where a liability stops. Every other stated purpose, tax, optics, ease of fundraising, is secondary and often misleading. The question to ask of any proposed structure is, when the entity fails, what does the failure reach? So the target shape is that family is on top, and that's divided in two parts. The first one is private discretionary trust, which refers to the succession and continuity layer. And the second one is the family holding company, or LLP, which is the aggregation layer. Put them both together, and below is the promoter group holding. As part of the promoter group holding, there are three things. There is listed operations company, the listed operating company, which is the plan, the approvals, the order book. Then there is the non-core new venture SPVs, and then the last one is the family assets like the residence or portfolio or foreign holdings. Now, as part of the listed operating company, we have the subsidiaries, or the subsidiary with the hazardous process, or a foreign subsidiary. It could be for marketing or service, or like a foreign factory or whatever, right? So the critical feature is not the boxes, it's the absence of arrows between the boxes at the same level. So no cross guarantees, no undocumented intercorporate lending, no shared banking convenience, and no common security package. So the specific design rules are, we segregate by failure mode, not by the product, right? Because they fail differently. So let me read that. It's too high tech for me to understand. Not high tech, but complex. The second thing is the holding company question, honestly. You know, a promoter holding company has real advantages. Ownership passes as a single block rather than fragmenting on inheritance. Family transfers happen at holdco level without touching the listed register. It is the single most effective structural answer to chain 4, which is fragmentation. But it also has real costs, like an additional layer of tax on dividends following up, mitigated but not eliminated by the intercorporate dividend deduction. The ITA 2025 section number and current conditions with your CA, we need to verify that. Anyways, there is an additional extra compliance burden, holding company valuation, discounts, and critically, creating it now means transferring listed shares, which triggers SEBI lock in capital gains and disclosure consequences that must be worked through before anything is signed by the council. Then there is the securities lawyers plus CA jointly, right? So they need to review that. Now, when I spoke with our CA recently, they said that we absolutely do not need a holding company. A trust alone is sufficient in order to save the tax and so on. But there is certainly some advantage as to why Cloud is proposing this. And the third thing is governance is a risk control, not a compliance cost, right? That's right. The fourth thing is DNO insurance and the specific trap, right? From what I've been told, we already have DNO insurance, so I'm gonna skip reading this further. Okay, wait, no. In the DNO insurance, given that we have that, I should read that there are three things we need to be mindful of. One is side A difference in conditions, right? So the layer that responds when the company cannot indemnify, which is precisely the scenario where you need it. And the second one is the conduct exclusions, and specifically whether they bite on allegations or only final adjudication. So, and the third one is the notification window, which is often very short and is the most common reason why Indian DNO claims fail. So, we need to confirm the coverage for regulatory investigation costs, which is what you will actually claim on, right? Now, the fifth thing, the design principle, is the key person insurance size to purpose, not a round number. We need to size it to the cost of recruiting and paying a professional CEO for 3 years, plus the refinancing cost if key person clauses trigger, plus a buffer for the revenue impact of the relationship transition, right? So then check whether any lender facility contains a key person or change of management clause, because most promoters have never read this clause in their own facility agreements. So note this as a key point. It's important. Then the business continuity as a document that has been tested, right? Yep, so we need to test one thing per year: a mock recall, a restore from backup drill, a simultaneous loss of the primary site, an emergency board meeting called on 2 hours notice. The value is entirely in discovering what does not work while it is cheap to discover. So this is important because from when I last asked, we only do fire drills. So this is also something that you need to remember. Then the second thing, not the second thing, but the second architecture is the family wealth architecture, right? So the first thing is the governing constraint, which is stated below, right? Every structure below is lawful. What determines whether a given structure is legal protection or or illegal evasion is not its form, but four things: when it was created, whether it was disclosed, whether it was taxed, and whether it is actually administered as it what it claims to be. Right? A lot of over here is not important to us for now. Well, the thing is, a lot of what we do is not in cash. It is we pay the taxes, we do it legally. So a lot of things over here don't apply to us, like the Benami property thing. We don't have a single property like that. Okay. There is a thing about beneficial ownership over here where they put something in bold, but I don't think that's the important part. The part is after any structure whose value depends on invisibility is not a structure, it is a liability with a delay fuse, which means design on the assumption that every structure is visible to the state because it is. And the single most important operational rule in this entire document: do the structuring in a calm year. A trust settled in a year with no litigation, no notice, no demand, no distress, disclosed on every return and administered properly for 5 years before anything happens is robust. The identical trust settled in a bad month is worse than useless. It is voidable, and it is evidence of intent, and it converts a civil problem into a criminal adjacent one. Now, the next thing is the vehicles assessed honestly. First one is the personal ownership by individual names. The role is the default: simple, cheap, transparent, and fully flexible. Advantages: no structure cost, no adverse tax layer, no SBO complexity, complete control. The disadvantage: it's a whole fucking paragraph. Disadvantages: it is the worst possible design for correlation. Every risk attaching to the individual, guarantee, matrimonial, tax, criminal, mortality reaches every asset they own simultaneously. Assets fragment on death across heirs, requires probate. The limitation is fine for a first generation entrepreneur with one business, structurally inadequate for multi generational family with a listed asset. Verdict: keep for genuinely personal assets, move systematic family wealth out of it over time. Then there is the family holding company, which is private limited, and there is a LLP, and there is a Indian private trust, and okay, I need to read the part for family holding company. So the limitation is that it solves fragmentation, it does not solve creditor exposure. The shares in the holding company are still owned by individuals and are still attachable. So the verdict is essential for a family with a listed operating asset and more than one heir. We need to consider that given that I have a sister and it's not the 60s anymore where the son gets everything. Okay, for the LLP, the verdict is sensible for a family investment vehicle, rarely the right layer directly above a listed company. Use a company here. We need to get a counsel on that. For the trust, This is the important one because we are considering that, and that is a very important layer. A trust is not a separate juristic person in Indian law, the trustees hold. The advantages is continuity, protection of vulnerable beneficiaries like a minor or a family member with disability, then the control architecture, the governance, and a neutral holder. The disadvantage is there is tax. A discretionary trust where beneficiary shares are indeterminate is taxed at the maximum marginal rate in the trustee's hands, historically under Section 164 of the 1961 Act. A specific trust, however, determines shares assessed on the trustees as representative assessed in the same manner to the same extent as the beneficiaries, but where the income includes business profits, the whole of it can be charged at MMR. This has to be verified. The tax cost of a discretionary trust is real and is the main reason to size and structure it carefully. Settlement is a transfer. And there is irrevocability is the price of protection. And then families consistently want the protection without the loss of control, and there is no version of the structure that delivers both. Trustee quality is the whole ball game. It does not defeat creditors and must not be designed to. The verdict is that it's essential as a succession layer for a family of this profile, which is us, but settled deliberately in a calm year with tax model beforehand and a trustee arrangement, typically a mix of family trustees and a professional corporate trustee that will actually function in 20 years. And there is wills, where the verdict is they haven't given a verdict. Well, that part is I think covered. I think it's fine. Then the HUF, the verdict is a document. What is in it? What is character is now. Consider whether documented partition. It's not important. Fine. Family constitution, fine. Family council, fine. Family office, okay. A family office, as the verdict is, it's sensible at the current scale. Start as a single professional plus outsourced accounting with the controls above from day one rather than added later. Essential above roughly 250 to 500 crores of family assets. Not there yet, I think, but we do have shares worth more than that. So what do we know? But that's not cash yet. And then the third architecture is international diversification. The purpose is geographic and jurisdictional diversification of risk, breaking the correlation identified in part 4, where a single currency, legal system, banking system, and political environment underlines the entire family balance sheet. The purpose is not concealment, and every element below assumes a full disclosure. For this, the lawful toolkit, it includes first of all the LRS route, the primary channel for the family, where the annual limit is 250,000 US dollars per resident individual per financial year. Then the second one is overseas investment by the family, ODI versus OPI. ODI stands for overseas direct investment, where it controls a strategic stake. From OPI is overseas portfolio investment, which is financial investment without control. OPI is available within LRS. ODI, however, is subject to specific conditions, including restrictions on investment in entities engaged in financial services, on structures involving layering back into India. For this, we need a council. A FEMA specialist should map any proposed foreign structure before it is created. And the third one is overseas banking and brokerage relationships, where it's important to open them early while everything is calm. Ensure more than one family member is a signatory. Then fourth is gift city or IFSC, the underused domestic option. This is interesting. The IFSC at a gift city offers a lawfully offshore environment inside India, including a family investment fund. This deserves serious evaluation because it delivers currency and market diversification with a domestic regulator and domestic advisors. We need to verify this. The current minimum corpus requirements, timelines, and eligibility with an IFSC specialist, because these have been revised more than once. The fifth one is foreign operating subsidiaries. The sixth one is international real estate, which is permitted under LRS. And there's the seventh one is residence rights and long-term visas, like a golden visa, I think. This is something that cannot be created under pressure. The two hard points is one is timing, and the second one is India does not permit dual citizenship, where OCI will only become the only fallback. And then there is the tax consequence. Then the eighth one is currency diversification. The next thing is the Indian tax residency. The point families get wrong. Residency under Indian income tax law turns on days of physical presence, with additional tests for Indian citizens and the person of Indian origin. A deemed residence rule for Indian citizens with substantial Indian income who are not tax resident anywhere else. Okay. Residency is determined annually and can change accidentally when a family member who spends a heavy travel year abroad may change status without intending to, with consequences for global income taxation reporting on both sides. Non residency is not an asset protection strategy and should never be pursued as one. It is a factual consequence of where someone actually lives. And the next one is the liquidity architecture. So the question that we are directly trying to answer with this architecture is, if the Indian operating companies stop paying dividends and Indian personal assets become temporarily inaccessible, how could the family lawfully maintain 2 to 5 years of normal living expenses? The answer is it is only done only by having built it beforehand. There is no lawful way to create this capacity after the event. Every attempt to do so is either a voidable transfer, a preferential payment, or an offense. So the section here is therefore entirely about pre-funding. Now this one is very, very important. 3 design corrections before the tiers. Correction 1. Normal living expenses is the wrong target. Size the requirement at 1.5 to 2 times normal annual outflow overall. Correction 2. The liquidity must sit outside 3 specific parameters: outside the operating company, outside the primary banking group, which may have set off rights, where a guarantee exists, outside the personal balance sheet of the guarantor. The third is subtle one, and it is why the liquidity architecture and family wealth architecture are the same problem. Correction 3 is accessibility is not a property of the asset. It is property of the asset plus the person who can reach it. An account only the promoter can operate fails in every scenario where the promoter is the problem. So, there are 5 tiers. Okay. Okay. Tier 0 or immediate, which is the access time is about 72 hours. It should sit in physical cash within legal limits. A current account at a bank with no relationship to the company or promoter's borrowings, or prepaid foreign forex cards. Then tier 1 is short, 3 days to 3 weeks, where you need overnight and liquid mutual funds, sweep deposits at institutions with no group relationship. Tier 2 is domestic reserve, where the timeline is 3 weeks to 3 months. And there is diversified domestic portfolio, gold, loans against insurance policies, and underused, fast, non-negotiable terms source, FD spread across institutions. Then there is tier 3 of offshore, where there is days independent of Indian access, which is foreign brokerage and bank accounts in USD and one other hard currency built up through consistent annual LRS remittances. And then there is tier 4, which is structural, which can take months. So foreign real estate that can be let or sold, family trust corpus, any genuine non-correlated income stream. Oh. So how do we build it lawfully from zero? Firstly, fund it from taxed income and disclosed sources only. Dividends, salary, documented gifts between relatives, sale proceeds of disclosed assets, and every rupee is traceable. The second is use the LRS capacity of every adult every year consistently. This is the mechanism that builds tier 3, and it only works if started early. The capacity does not carry forward. The third is gifts within the family are the ordinary route to spreading ownership. We need to note the clubbing provisions, however. Fourth is document every gift with a deed, a bank trail, and a written disclosure. An undocumented gift is a benami risk and a matrimonial dispute exhibit. Fifth, do it now at a steady annual rate in years when nothing is happening. A 10-year program of routine annual transfers is unimpeachable. A single large transfer in a bad quarter is not. Sixth, never fund it from the operating company. other than through declared dividends or contracted remuneration. So there is one test we need to run this year. Have the family attempt on a Monday morning to pay 25 lakhs invoice using only tier 0 and tier 1 assets without contacting the company's bankers or the CFO. Most families discover in that hour that the entire liquidity runs through two people and one banking relationship. That discovery is the point of the exercise. This one is very important, very, very important. You need to make a keen note of this. Then E is the control architecture, where we will be looking at how the control is lost, and it can be lost in 6 ways. Each has a specific unglamorous countermeasure, and none of the countermeasures work retrospectively. Dilution. The first part is dilution. Mechanism. Each fundraise, ESOP grant, convertible issuance, and preferential allotment reduces promoter percentage. No single one is alarming. The cumulative effect over 5 years is the countermeasure is one standing board discipline. No equity issuance is approved without a table showing promoter holding pre and post issue and the cumulative position after all outstanding instrument convert. Second, the supporting measure, we need to set a floor. Know the maximum permissible non-public shareholding. And the rebuilding tool under SEBI SAST regulations 2011, a promoter holding above the initial threshold may acquire up to a specified percentage per financial year without triggering an open offer, subject to the ceiling on non-public shareholding. We need to verify this. The exact current percentage and condition with Security Council. The creeping acquisition route is the lawful way to rebuild a diluted position gradually, but it requires cash outside the company, which returns to Part 5D. Then there is inheritance fragmentation. Then there is pledging. And there is divorce. And there is family disagreement. And then there is death and hostile acquisition. And F is physical security architecture, and there are 3 principles before any specifics. Security begins with professional threat assessment and not with equipment. Then there is the highest value control is staff vetting, not hardware. And then 3 is nothing in this section describes operational tradecraft. So we go by escalating levels. The first one is residence, then office, then vehicles, then travel, domestic, then travel international, then children, and then major events like weddings or functions. The 3 protocols every family should have written down. Family emergency protocol. A code word that means come home now, ask nothing. 2 muster points, 1 near home and 1 outside the city. A nominated out of area contact whom everyone calls when local communication fail. The classic failure in a real emergency is that everybody calls each other and nobody gets through. And one must always carry a grab pack, passports, essential documents, medication, cash, a charged basic phone, and it has to be reviewed annually, practiced just once. The second is staff protocol. The third is kidnap and ransom preparedness at the policy level only. KNR insurance exists and it is available in India for families of this profile. For this, it is important that we retain a specialist response consultant. The confidentiality condition is critical. For disclosure can void cover. Pre-designate a single family decision maker who is most likely not the target. Multiple family members negotiating independently is most common failure mode. Proof of life protocols exist and are established with the response consultant in advance. No further details. Report to police. Whatever else, that is not a decision to make in the moment. It is a policy to have decided beforehand. Then there is the digital security architecture. The domain one is the promoter family, where the hardware security keys or app-based MFA on every account. And there is separate personal and business email and devices with no crossover, which breaks chain 12 at its origin. A password manager for every family member with unique passwords everywhere. The promoter's DSC in his own physical possession, never held by a consultant or company secretary. And there is the dual channel verification on all financial instructions, like callback on a pre-registered number, never a number in the request. Social media discipline across the family, including the second generation. No real-time location, no travel in progress posts, restricted audiences, no photographs revealing home layout or security arrangements. Encrypted messaging for family and sensitive business matters. Annual credit report and MCA filing check. A written rule that no family member ever authorizes a payment on a voice or video instruction alone. Domain 2 is the family office, which we don't have right now. So that's there. We'll read that later. The domain 3 is the operating company, which I think is in good hands right now. We have IT enterprise. We have the plant with a separate program, IP protection, DPDP readiness. Matrimonial risk. The first one is okay. This one is part 6 now. Okay, wow, we got done with the architecture. Wow. Part 5 is done with the resilience architecture, which again includes corporate, family wealth, international diversification, liquidity, control, physical security architecture, and digital security architecture. Okay. Now we come to part 6, which is the matrimonial risk. I think I don't need to read this one tonight, given that I'm far from being married and my mom would not do that. Okay, we are jumping to part 7, the family fortress stress test. 10 combined scenarios for each: what happens, what the architecture does, where it holds, and more usefully, where it breaks. A stress test that everything passes is badly designed stress test. Test 1. Something happens to the MD, the stock falls, and the family disagrees over succession. So the architecture response is the board approved emergency succession plan activates within 48 hours. Hold core, the trust means shares do not fragment or require probate to be voted. A family council convenes with the pre-agreed decision rule. Key man insurance fund stabilization. The asset register means the will and the documents are found on day 1. Verdict survives conditional on 3 things being real: that the emergency plan names an actual person, the family council has a decision rule for deadlock, and the second line is genuinely capable rather than nominally designated. Yes, where it breaks is if the succession authority is documented but legitimacy was never built. A successor who has the legal right to lead but not the confidence of the customers, the banks, or the senior team fails within a year. Legitimacy is built over a decade in front of witnesses. It cannot be conferred by a document. This is not politics. We are not Rajiv Gandhis. This is the strongest argument for giving the next generation real, visible, accountable operating responsibility early. Test 2. Serious investigation plus assets frozen plus media crisis plus banks turn cautious. The architecture response: retained counsel engaged within hours. Tier 0 to 1 liquidity at an unrelated institution funds legal fees and family costs. Tier 3 offshore liquidity is unaffected by Indian account constraints. Multiple banking relationships means not all facilities move at once. The professional management layer keeps the plant running while the promoter is consumed. DNO responds to the investigation costs and the pre-drafted holding statement goes out within 4 hours. And this would survive if and only if Tier 3 was funded in advance and is operable by someone other than the person under investigation. It would fail if the family's emergency liquidity sits at the same banking group as the company's facilities. And B, if the offshore account has a single signatory who is also the person subject to travel restriction. Both are cheap to fix and almost universally unfixed. Test 3. A promoter's child. Contentious divorce plus shares in family property disputed. Not there yet. Test 4 is major factory accident plus criminal investigation plus 500 crore civil exposure. So the architecture response is insurance program with liability limits stress tested against a realistic maximum loss rather than a historical premium budget. Okay, I'm tired. Test 5. Field failure flagship customer plus vendor delisting plus guarantee invoked. Test 6. Ransomware. Test 7. Promoter incapacity. Test 8. Anonymous research report plus independent directors resign. Okay, that's not gonna happen. Test 9. Capital controls plus INR crisis plus children studying abroad plus no foreign liquidity. Again, there is importance on Tier 3 offshore liquidity, which is built over years of consistent LRS remittance and disclosed on Schedule FA. Is denominated in the currency required and is already outside the restricted channel. Foreign brokerage relationships were established when it was easy. More than one family member can operate the accounts. Test 10. Sibling dispute. So what the 10 tests reveal is the finding is liquidity outside the company is the load bearing element. The personal guarantee is the single most dangerous document the family holds. We don't have that. Structure cannot substitute for culture. Some risks are irreducible, and the cheapest intervention carry the most weight. Part 8. Benchmark family business failures. The structural lesson does not depend on the truth of any allegation. A family is damaged by an allegation whether it is true or not. It is itself one of the lessons. So, in Indian cases, we have first of all Raymond and Gautam Singhania, the irreversible gift where the father transferred his son all of his shares. The lesson over here is never depend on the future goodwill of a person to whom you have already given everything. Structure the transfer so that the transfer's security does not require the transferee's cooperation. This costs nothing at the time of transfer and is impossible afterwards. Number 2, Reliance Ambani, the cost of intestacy at scale. If the founder does not decide, someone else will publicly, expensively, and possibly not in the family's interest. The case is also the strongest available argument against the common promoter's instinct that writing a will invites bad luck or invites conflict. The absence of a will invites both. Then there is the Singh brothers. The lesson is a liquidity event is the one moment where diversification is free. Families almost always redeploy into things that look different but correlate completely. New ventures funded by the same family, cross guaranteed with the same people in the same country. Ring fence a fixed percentage permanently before deciding what to do with the rest. Then there is the Kingfisher, UB Group, Vijay Malia. Listen, the personal guarantee is the mechanism by which corporate risk becomes family risk. Everything else is commentary, and post May 2026 with mandatory 14-day admission and no interim moratorium for personal guarantees, the mechanism is faster than it was when these events occurred. Then there is Videocon and Doot. The lesson, and it's newly urgent. A subsidiary is a firewall only to the extent it is financially independent in substance. The IBC Amendment Act 2026 introduces a statutory group insolvency framework which makes this lesson considerably more consequential than it was. Any assumption in the family's current structure that a subsidiary insulates the parent should be re-examined with insolvency counsel against 2026 position, not the 2019 position. And there is the Diamond Power Infrastructure, a local case. The lesson is the fastest growing years are the years where governance most needs to be ahead of the business, and are the years when it is most often behind it. Growth absorbs management attention and controls are first thing deferred. Being in the same industry and the same city as a cautionary case is an argument for building governance ahead of scale, not for assuming it could not happen here. There is a lot of reading. I'm not doing that. There's international cases for Hermes and Gucci and Bezos and Scott divorce without control loss. That was a positive case. So the composite pattern across all 12 and the same six structural failures reoccur. The recurring failure is no succession documentation, no will, no trust, no agreed rule. It is affected in Reliance, Gucci, and Bancroft. The second is ownership fragmented with no decision mechanism. Bancroft, Gucci, and Murdoch. Personal guarantees and cross collateralization converts corporate risk into family risk, which is the case for Kingfisher, Videocon, and Diamond Power. And there is concentration surviving a liquidity event, which is for Ranbaxy, for no liquidity to fund of an internal buyout, so the dispute is resolved by an outsider. That's the case for Bancroft, Gucci, and Murdoch and Bezos. And irreversible transfers without retained security, that's the case for Raymond. Okay, we are at part 9 now. That's fine. And part 10. I'll leave 9 and 10 for later, but they are the important ones. 9 is the promoter family resilience dashboard, and part 10, most important, implementation. That for the next video. For now, it's been 52 minutes and I'm tired because it's like 3:50 a.m. now. Peace.